Good afternoon, everybody. Welcome back to my channel. My name's Max. I appreciate you guys for being here. Let's look at the agenda real quick, okay? All right. So today, let's go over Defiance and Yield Max first, and then at the end of the video, I wanted to review my video that I just released today about using options in retirement. Then I wanted to look at a viewer question about whether or not I was still an IWMY fanboy. And I also wanted to look at a comment from Com, one of my favorite commenters. That should keep us pretty busy. Well, let's do these Defiance profit boxes first. Let me share this Defiance screen with you. All right. So, yeah, bad day for the indexes. NASDAQ anyway. Same thing with the S&P. Just S&P took back all of yesterday's breakout. Just makes yesterday's breakout look like a fake out. You know, right now it does. Let's go back to the NASDAQ. Yeah, NASDAQ, it did well more than that. It took back the breakout of the past, like 1, 2, 3, 4, 5. The past week, there was a break above this level that it almost took all of that back. All right, so now the good news is Russell was up and closed on its highs. Okay, so a lot of the stocks in the Yield Max universe are doing just fine. So let's look at the Yield Max stocks first. And then we'll look at the Defiance stocks real quick. But let's start with Tesla. We'll just do the little rundown. Okay, Tesla's not one of the ones that's fine. This is really helping out Crash, which is the inverse Tesla. It was up more than, it was one of the funds that was up the most today. In fact, I think it was up the most. Look at all Crash finally making everybody proud, up 8.71%. Now let's see how much Tesla was down, 6.7. So yeah, it's still a kind of a difference there, but it's not as bad as it has been. And I imagine it'll keep getting closer as hopefully the volatility will revert back to normal. This has kind of been a little crazy thing, what's going on, but who knows? Maybe volatility is here to stay in Tesla / Crash. All right. Well, in my video today about how to hedge $1 million, I incorrectly said that the Tesla managers were using the prayer method. Actually, the Crash managers were using the prayer method, because they haven't been rolling aggressively. They're just praying that these options the market will come back to their options. As long as the market goes this way, the problem with selling covered puts is the covered part. To do a covered put, you have to have short stock or a short synthetic. Anyway, these guys have a short synthetic, but so they've ridden this short synthetic all the way up from 187 to 270. Rode it all the way up, took a loss all the way. These option premiums, they cushion the blow a little bit, not very much though. In any event, but the prayer method finally worked. If it would be great if for these guys, for the Crash managers, and I think it's the same guy that does Tesla. Anyway, be great if it would just come back here and just close at max profit for these strikes. That just and then just bounce around for a while and let the market and let the option and let volatilities catch up with where the market is. But in any event, and just let some time decay happen for a while. This has been a crazy move, and it hurt Crash something awful. The funny thing was they have an option, a 265 strike price option, just for emergencies. It's supposed to keep them from losing like really a lot of money. And that would have kicked in, and it did for a little bit. But all right, so we'll see what's going on here. We'll see what continues to go on there. So Coinbase, they're in good shape. They have room for upside. That's fine. Nvidia's pulling back. They have plenty of room for upside. We'll look at AMD, and now AMD had a nice end-of-day turnaround there. AMD's been acting a lot stronger than Nvidia lately. I don't know if AMD calls are in order, but I don't know. Who knows? Let me know what you guys think. If I do it, I'm a jinx, so I try not to do directional stuff. Let's see, what else do we have? Let's look at old Mr., which is MicroStrategy Inc. Now, these guys are in a good situation for their ladder. They've been kind of going up this week, and they're getting close to max. I mean, they still have a little bit more room for appreciation, but they're close to max being topped out for the week. All right, so now let's look here at my new favorite one, USO. So these guys, this is what USOY, the new Defiance oil fund, or it's not that new. You can see these profit boxes. So it's about, what is that? Got here this middle of last month, 15. So it's almost a month old. It's coming up on a month old. These funds grow up so fast. They introduce them so fast nowadays, I can barely keep up with them. There's another 4 or 5 that came out this week. All right. So USO's chart is also, they made a nice end of day recovery, kind of like AMD, but I'm not comparing USO and AMD. But this is an interesting chart to me. So the thing about this is we only have 1 day left, and they sold the 82.5 strike put option. So they have a long way where they can appreciate for USO, where it can still go up before they're capped out. Probably too far. It's probably not going to be able to get there. We'll see what happens though. But this one's nowhere close to being capped out. These guys are doing a great job. And if it doesn't get there, well, hopefully it gets as close as possible, because the closer it can get there, the less the position will lose. If we can at least get to the bottom line on the profit box, the position will break even, because this option brought in premium. So, all right. So now let's look over here. Right. Okay. Did everyone see that video? How to use options in retirement? We'll look at option strat in a second. And then I got a letter. Am I still an IWMY fanboy? We can look at something on that in a second. We'll compare IWMY and some of the alternatives. Then I just wrote some comments down that I was thinking whenever I was designing this slide. And I also wanted to talk about a comment from Tommy, and he made a comment about IWMY also. We'll look at his comments so I don't misquote him. First things first, like I said, here is the $1 billion baby. There's 2 strategies. One costs about $15,000. One costs $35,000. I prefer the $15,000 one, but it only insures the portfolio for $1 million till September 30th. That's this one right here. Let's take a look at that one right here. So here's the profit and loss graph right now on this one. And this position was put on paper yesterday. Max profits, $1.1 million. It's supposed to, this insures $1 million. This is $1 million of insurance. The market keeps going up or whatever. If you aren't right, if the market doesn't, by expiration, doesn't go down at least 5.6% plus then some, if it doesn't go down at least that far and you reverse it, then you're going to lose most likely $15,000. These options are bleeding. That's what I call bleeding, but it's because you own more options than you sold. It's a spread, and there's some sold options in there as well, but this is a long volatility spread or strategy. So what we're going for is either something happens quick, and if that does, that's fine. Like on Monday, boom, the market down 10%. Okay, that sucks because we have $1 million portfolio. We had $1 million portfolio, but now we only have a $900,000 portfolio, right? Okay, well, our option position is worth $113,000. So that's what I'm trying to show, option positions that aren't for gambling or YOLOing. This is what I would consider a decent, a decent return on investment and a decent play for your money. Yeah, if the market keeps going up, or if the market goes sideways or goes down but doesn't drop far enough, you're probably going to lose the $15,000. But $1 million account that's in growth is up 20 or 30% this year. $1 million account that's even in 60-40, just because the growth sleeve, look at VU or VTI or Qs or SPY, they're all up 20, 30 and more percent. So the growth component of the 60 is doing great. So this would be a great time, in my opinion, being up $300,000 on $1 million retirement. If you have a $2 million retirement, and it depends on how you're allocated, but look at your paperwork. But now the drawback is you have to come up with the $15,000 in cash, and the other things on paper. But if the market takes a dip here before the election, I think these things can really pay off. Anyway, we're going to start following this every day, or we're just going to look at the spread and see how it's doing. So, but it's just right there and saved. I've shared the links before, and then we have a New Year's edition. It's a $34,000 trade. It's up $3,100 today. It was theoretically put on at the close last night. I did this last night just using yesterday's close. I didn't know the market was going to drop today, but it's so far, I will say this hasn't turned out to be a great investment, because the market dropped. Well, the S&P was down. Let's look real quick. What was the S&P down? Well, the Qs were down 2%. I mean, the S&P was down 88, basis points. So, $8,800 today. You're down to $8,800 today. Well, okay, great. The spread in this case was up 3,100. So you offset some of that. I forget where it showed that. It's $1 million baby New Year's Eve edition. So your account would be down, about 8,000 today on paper. That's just a paper loss, but this is a paper gain as well, because you aren't cashing it in. But anyway, watch the video if you haven't, because as the losses pick up, you can you can make more money, because if the market's going to drop, volatility will pop, and then you can have a situation where in a market that's down 15%, where you can have, granted it's on paper, but you can be up $176,000. And you can cash it in, and you can do all kinds of things at that point. You have options at that point. You can roll it. There's all kinds of things, or you could do nothing. And I showed in my video that probably doing nothing's the right thing to do. So go watch the video. Okay, so now let's look at some comments. Okay, so I got a comment. That's Tom's. Well, it was a guy that said, because I made a video a long time ago, like back in December, and IWMY was going up every day at the same time volatility was increasing, if I remember the particulars. And I was going, man, I'm a fanboy on this one. Well, anyway, so yesterday, I guess IWMY was down, because I got the comment a couple of days ago. Let's look at the chart. I think this was actually yesterday. Within the past day or two, I got this, and they said, are you still a fanboy? And I didn't respond to it, but I think they meant because it's been kind of the more disappointing one of the three, or that's kind of the way I take it. But yeah, I was going to tell them, and I thought this would be a good topic here. Let's see. I want to make sure this is, so y'all can see this. Okay, yeah. I want to tell them that, yeah, of course, I actually am, and I'll show you why. Because let's see. Let's compare, just let's say since the first of the year. Now it has to be a fair comparison. So another, high yield IWM Russell fund. There's not a lot of them, but we'll look at a couple of them. But it has to be a fair comparison. So here's the Global X Russell fund. So, and this is just since the start of the year. Or no, this is since inception. This is since inception, which is just okay. So IWMY versus Russell. These things aren't designed to outperform the underlying, and this hasn't. So the Russell, the underlying, is up 24%. The IWMY is up 11, so about twice. And that's about what we'd expect. The daily funds have a ton of buffer, so they don't get very much downside, which is good in a down market. We haven't had one, but that's bad in an up market. All right, so we can also look at it this way, though. Let's compare it to like an alternative investment. So we can compare it to the Global X Russell-based fund, and there's some new ones out too. So let's compare it to those and see. It has to be an apples to apples comparison. So it does a lot. It appears to have better total return than the Russell one. So the total return, and this is not annualized, is 11% in 3/4 of a year. I mean, I'm happy with that. The Russell high yield fund is almost 7%, which is decent as well. So the thing about this one is, though, that this one is up 11% total return, and it received $8 of that in dividends. So that's a lot of dividends. I mean, to me, that's, on a $20 initial investment, granted, it's only worth 13 at the end of the time, but whereas you could have get the Global X one, sure, and it started at 16 and it's still worth 16, but it only paid $1. It paid about 1/8. I mean, that's a gigantic difference. I mean, you can do a lot of things, in my opinion, with that extra, or maybe 7x with that. It's a lot of extra money. I mean, you have to watch out for the you have to watch out for the NAV depletion. You have to be sure to account for that. All right. So let's look at it this way. Let's compare IWMY to the new IWMI that just came out. And this is, I think, a stablemate of SPY and QQQI, which are great funds. So, and this is going to be really short comparison. What is this? This is 2-3 weeks, maybe at the most. Okay. Well, we can see that, really short time period, but one of them's up 158 basis points. One of them's up 142 bips. So, it's about a 10% difference, maybe, if that, not that much. But IWMY is outperforming in this short time frame. And we can also look at dividends, even though this probably means just both of them have just had one dividend. But in that time, it looks like IWMY paid 70 cents on their one dividend. IWMI paid 55 cents on their one dividend. So that's great. And you could say that's roughly the same, except for the fact that IWMY stock only cost $14 to get that 70 cents, where IWMI stock cost $50 to earn less, to earn 55 cents. So I think that's where the advantage of these daily funds come in. And when the market drops big because of all this buffer they have, they drop much slower than other assets, and definitely than the overall market. All right. So now Tom asked me a related question. He said, I should have just left it up. Tom said, okay, he said, well, let's just see what he said. I guess we can just see what all Tom said. Okay, Tom said, Max, for IWMY, the share price has decreased by 30%. True. So the 30% of the decrease in next month's distribution is due to the share price. The rest is decreased volatility. Okay, well, we're definitely having decreased volatility. Yeah. Okay, well, definitely, I agree with the first part. So IWMY now it hasn't dropped this month. It's dropped 30% since inception, and that's been like, 8 months or something now. So, but so the 30%, over the past 8 months, that's true. That 30% has been robbed out of the returns, because for sure. But of course, they're paying you too. So it's it's going in another pocket, and it's going a little faster because on total return, it's up pretty good, and it's outperforming competitive investments. But yeah, that's definitely something you have to factor. You have to be aware that's going to happen. But there's good alternatives too. like I say, that RYLD, that was steady as a rock, began and ended at the same price. IWMI began and ended close to the same price. They're steady. They just pay less dividend. The big dividend, that's what I'm trying to get people to see. The big dividend is the buffer. Well, that's so the ones that pay more are also the ones that erode more. There's no getting away from them. It's just like there's no free money. So if you have one that's paying 100%, it's also going to have potentially the worst problems with NAV depletion. Now it varies from time to time, but in any event, all right. So that's my talk on that. I want to make sure I covered everything here. Oh yeah. So all I was going to say is, okay, so none of this stuff is new. Dividend traps have been around for years since I was selling stocks to, I was on the other side of the desk. In the 90s, you'd have a stock that all of a sudden is paying like the 12% dividend, and like a decent stock, a big brand name company you've heard of or something. But then when you look into it, you discover that they've been taken over by private equity, and they've sold off all the good assets, and they're cannibalizing all the bad assets, and they're paying a bigger dividend to pay off the bankers and stuff. And it's not real. It's fake money because they can't duplicate it. Once the money's gone, the money's gone. I guess maybe they're I shouldn't be that negative. They're maybe hoping, like, real optimistically, for a great economy. Maybe if the economy keeps going great and everything, whatever business model they have will keep going, and they'll be able to, pay the bankers off and stuff. But whenever a 2008 or something comes along, all these kinds of businesses go belly up. Well, that's what a dividend trap for years has been. Or a dividend trap maybe is like a company that in the board of directors doesn't have much imagination. So they're just paying a huge dividend when really they should be doing something way better with R&D and trying to develop a new stream of income. And so that, and people would say that's a dividend trap. So no, that is a definite thing. And that to me is what they really are. These high yield funds, people refer to them as dividend traps. And some of them become NAV traps. So, I mean, I'm just trying to, because if you invest in a high yield fund and the underlying that the high yield fund tracks goes the wrong way, like what happened to Crash lately, I mean, there's nothing you can do about that. But that's the same if you make any investment. Bonds don't insulate you that much. When you invest in bonds, they say it's safe. Yeah, you get a 3% return from the government and stuff, but the market crashes, interest rates generally blow up, and your bond position, it may be guaranteed and you won't lose money, but your NAV, your net asset value will go down. It'll look like it'll make you mad. Same thing that happens whenever the market pulls back 5%. And even if you have a great covered call fund, that's fine and you're fine or whatever, it makes the NAV go back. It has to. It has to go, and the market going up and down has to be expressed somewhere, and they generally express the option premium with the monthly distribution more so, and they generally, the NAV is generally takes place in the market moving up and down is manifested in the NAV moving up and down more times than not. Now they do pay some of the NAV in the distribution sometimes, but that's just only on these ones that are up a lot. I think they've done that, and it looks like they've done that a few times in some of these high flyers, some of these yield max ones. All right. So what was I trying to say here, though? To me, when you compare these high yield ETFs compared to in the old days where you had a bond portfolio, maybe you had some high yield corporates, and you had a diversified portfolio of government and corporate bonds, and those were fine and everything, but those didn't insulate you that much, and they did not earn that much income, so they did not give you that much buffer. And I just think it's with the real ability to earn yield easily, with the diversified portfolio, 10 or 15% without much effort and without taking on that much risk. Whereas that's, triple what you're making in bonds. I mean, it's an interesting time for these type of investments. I was trying to get Jay that one time that I was trying to in New York when I asked him, I said, and I asked Chris Mullen, the manager of Tesla, I said, hey, if interest rates go back to zero, and won't that make these less attractive as investments? And my theory is because the volatility of the market also follows interest rates. So the VIX will come down if interest rates go back down. I'm just saying that these will, not only will the bond portion, a lot of these are just basically they own T-bills. So that part will make less money, but then also the part about them selling options, there'll be less premium coming in. And I know the answer. I don't have to have them tell me these will become less attractive. I'm just trying to get them to tell me how much less attractive. Well, Jay made a case that they aren't going to be that much less attractive. He says, but they might be 1% less attractive. So, in any event, I don't know. Let me know what you guys think. I'd like to hear your opinion too. My idea when also I was going is, so another thing that somebody could do is they could invest in REITs or physical real estate in real life, whatever. But once again, you're tied to the economy. If something bad really happens, that's going to take stocks down, it'll also take your REITs and your real estate down. It's not like you can't invest in some stuff, gold, and I'm not saying you can't find a hedge somewhere, but your conventional and your non-conventional income investments are, they're all kind of a rising tide, lifts all ships. But I think if we know that and we allow for that, and some of these investments, especially in the alternative universe, and especially with these options, they behave vastly different than other ones based on the strategy. Anyway, that's where I like to come in. So we're going to skip the Tesla pre-earnings play and the GME meme play. None of those really took off yet. We're still tracking them on paper. We'll talk about them in the morning, but we covered Defiance, we covered Yield Max, options in retirement. That's a good video, but watch it because there's a lot of watch it and send me questions. I'm going to make more in that series, but send me questions on that $1 million video. And then I'm working on finishing up the video with Howard Chan from Curve. So I will get that out tonight, and then we can talk about that tomorrow. But anyway, I really want to hear what you guys have to say about all this stuff I was talking about tonight. And if you tell me how you guys are, do you guys think it's time to hedge? Anyway, I mean, yesterday would have really been the time before the market dropped. It's not too late though. The market's still within like 0.5% of all-time highs or something. But anyway, let me know what you guys think. All right, guys, I really appreciate y'all, and I'll talk to you later.